What if the people managing your retirement have already decided America's best days are behind it and repositioned your savings without asking you? I'm not talking about some fringe hedge fund. I'm talking about the three companies that control more money than any entities in human history. BlackRock, Vanguard, State Street. Between them, $30 trillion. Let that number sink in. 30 trillion. That's more than the GDP of the United States and China combined. These three firms are the largest shareholders in 88% of S&P 500 companies. Not some of them, 88%. Apple, Microsoft, Amazon, Google. The big three are the biggest owner of all of them. And those target date funds that hold your 401k, the ones your HR department auto-enrolled you into. 98% of 401k plans use funds dominated by these three companies. Here's what they're not telling you. Vanguard and State Street target date funds already have 40% international equity exposure. 40%. The money you thought was betting on America? It already isn't. Not fully. And every quarter, that allocation shifts a little more toward the exits. You didn't make that decision. You weren't consulted. The people who manage your retirement made a bet, and they didn't tell you what it was. In March 2025, Larry Fink, the CEO of BlackRock, the man who controls more money than any human in history, told investors that the fundamental model of investing your parents relied on is dead. The 60-40 portfolio? The bedrock of retirement planning for 50 years? Gone. What's replacing it? Why weren't you told? Let's follow the money. To understand what's happening, you need to understand the man at the center of it. The year is 1986. Larry Fink is a rising star at First Boston, one of Wall Street's most prestigious firms. He's pioneering a new product called mortgage-backed securities. He's on top of the world. And then, in a single quarter, he loses $100 million. In 1986 money, that's catastrophic. His career is over, his reputation destroyed. Most people would have disappeared into obscurity. Fink did something different. 2 years later, in 1988, he founded a new company built on a single obsession: risk management. The company's first product wasn't investments. It was a risk analytics system called Aladdin. Today, Aladdin monitors $21.6 trillion in assets. Not just BlackRock's money. Hundreds of institutions, including BlackRock's competitors, pay to use Fink's system to understand risk. Think about that. The world's largest asset manager also runs the risk system that everyone else depends on. That's not a conflict of interest. That's an information empire. But here's where it gets interesting. 2008. The financial system is collapsing. Lehman Brothers is gone. AIG is dying. The US government is panicking. Who do they call? Larry Fink. BlackRock wasn't just bailed out like the banks. BlackRock was hired to manage the bailout. They handled the $150 billion AIG rescue. They managed the $45 billion Bear Stearns toxic assets. Larry Fink went from Wall Street pariah to the most powerful man in finance. And the US government made him that way. Now, here's what makes Fink fascinating and dangerous. He's a lifelong Democrat who joined Donald Trump's Economic Advisory Forum. He's the world's loudest champion of ESG investing, environmental, social, governance, the whole green finance movement. He's also the manager of the world's largest fossil fuel portfolio. He warns about the dangers of the US debt crisis, while his assets under management hit all-time highs. Fink isn't an ideologue. He's a survivor. And survivors don't make bets. They hedge them. Which brings us to March 2025. In his annual chairman's letter, the most read document in finance, Fink wrote something that should have made headlines everywhere. The future standard portfolio may look more like 50-30-20, stocks, bonds, and private assets like real estate and infrastructure. Let that sink in. The CEO of the world's largest asset manager just told you that the investment model your parents relied on, 60% stocks, 40% bonds, is dead.
And he told you what's replacing it.
This isn't speculation. This isn't a prediction. This is the man who manages $14 trillion describing what BlackRock is already doing. And if you don't believe the words, look at the money. In 2024, BlackRock acquired global infrastructure partners for $12.5 billion, creating a $170 billion infrastructure platform spanning 300 investments across 100 countries. They're in the process of acquiring HPS Investment Partners, which manages $220 billion in alternative assets. And the AI Infrastructure Partnership? $30 billion committed, with a target of $100 billion, building data centers with Microsoft, MGX, and NVIDIA. BlackRock's alternative investments grew 49% in a single year, from $455 billion to $676 billion. This isn't diversification. This is a pivot. But the most explosive thing Fink said wasn't in his letter. It was in an interview in April 2025. He warned that if the US doesn't get its debt under control, America risks losing its reserve currency status to digital assets like Bitcoin. The world's largest traditional asset manager just endorsed Bitcoin as a potential dollar replacement. This isn't a crypto bro on Twitter. This is the man who manages more money than the GDP of every country except the United States and China. Something happened that made Larry Fink say that out loud. Something that changed the calculation for every major investor on the planet. It happened on a single day, in February 2022. February 26, 2022. 2 days after Russia invaded Ukraine, the G7 nations did something unprecedented. They didn't just sanction Russian oligarchs. They didn't just freeze Putin's personal assets. They immobilized approximately $300 billion in Russian central bank foreign exchange reserves. Let that sink in. A sovereign nation's central bank reserves, the most sacred assets in global finance, theoretically protected by international law, were seized overnight. Now, you might think this was just about punishing Russia. And yes, that was the headline. But here's what actually happened in central bank boardrooms, from Beijing to Riyadh to New Delhi to Brasilia. Every single one of them did the same calculation. If they can freeze Russia's reserves, they can freeze ours. The dollar didn't just remain the world's reserve currency that day. It became a weapon. And weapons, by definition, can be pointed at anyone. Larry Fink saw it immediately. Just weeks later, in March 2022, he wrote to shareholders, "The Russian invasion of Ukraine has put an end to the globalization we have experienced over the last 3 decades. This wasn't hindsight. This was the world's most powerful investor announcing in real time that the post-Cold War financial order was over." So, what did those central banks do? They started buying gold. A lot of gold. Before 2022, central banks bought an average of 473 tons of gold per year. Normal diversification. Nothing unusual. In 2022, 1,136 tons, the highest since 1967. 2023, 1,037 tons. 2024, 1,045 tons. 3 consecutive years above 1,000 tons. In just 3 years, central banks accumulated over 3,200 tons of gold, worth more than $300 billion at current prices. Do the math. That's roughly equal to what was frozen from Russia. Let me show you who's buying. China. Official gold reserves reached 2,300 tons by late 2025. But analysts estimate their actual holdings could be double that, over 5,000 tons. Why the secrecy? Because at the same time, China reduced its US Treasury holdings by $281 billion. By September 2025, they hit a 17-year low. Russia. Gold now makes up 42% of their reserves, up from 30% just 2 years earlier, worth over $300 billion. They essentially sanction-proofed their central bank. Poland, the largest buyer in 2024 at 90 tons.
Their central bank president publicly announced they're targeting 20% gold allocation.
A NATO member, hedging against dollar dependence. India, the Reserve Bank purchased 73 tons in 2024 alone, 4 times the prior year. And here's the detail that should make you pay attention. They repatriated 100 tons of gold from the Bank of England back to domestic vaults. Physical possession matters now, that's the message. But don't take my word for it. The World Gold Council surveyed central banks in 2025 and asked them directly about their plans. 95% expect global gold reserves to increase over the next 5 years. 43%, a record high, plan to increase their own holdings. And here's the number that should stop you cold. 0% plan to decrease. 0. Not a single central bank in the survey plans to reduce gold holdings. This is as close to unanimous consensus as you get in global finance. And in 2025, we crossed a threshold that hasn't been crossed in roughly 3 decades. For the first time since the early 1990s, gold has surpassed US Treasuries as a share of central bank reserve assets globally. Governments around the world are collectively deciding that a 5,000-year-old metal is a safer store of value than the debt of the world's largest economy. Central banks moved first. They had to. Their reserves were on the line. But they weren't the only institutions watching. Across Europe, the people managing your pension were doing the exact same calculation. Now you might be thinking, central banks are governments, they play politics. What does that have to do with me? Here's what. In late 2024, when the Trump administration started making aggressive statements about annexing Greenland, something unusual happened. Danish pension funds didn't wait to see if he was serious. They started selling. Academica Pension, a $24.5 billion fund managing retirement savings for Danish academics, their chief investment officer, Anders Schelder, publicly announced they would sell US Treasuries if annexation proceeded. His words, "We have to consider whether we can trust the US as an ally." But it wasn't just one fund. PFA, Denmark's largest commercial pension fund, their chief strategist, Tine Choi Danielsen, stated publicly that they had exited US Treasuries due to political risk. I want you to understand what those words mean. Political risk is language you use when talking about emerging markets. Venezuela, Argentina, Turkey, countries with unstable governments and unpredictable leaders. Using political risk to describe United States government bonds, the supposedly safest asset on earth, would have been unthinkable 5 years ago. In December 2025, Danish pension funds collectively sold approximately 10 billion Danish kroner, about $1.4 billion, in US Treasuries, in a single month. This wasn't about yields. This wasn't about interest rates. This was about fundamental trust in American political stability, from a NATO ally. And Denmark wasn't alone. A survey in July 2025 found that 63% of European institutional investors had reduced their US exposure, not considering reducing, had already reduced. And the financial incentive was obvious. In 2025, European stocks, the MSCI Europe Index, returned 36.25%. US stocks, the MSCI USA Index, returned 17.75%. European investors who stayed home doubled the returns of those who bet on America. That's not a rounding error. That's a fundamental shift in relative performance. But perhaps the most symbolic move came from the Netherlands. PFZW, the pension fund for Dutch healthcare workers, managing €259 billion, ended their relationship with BlackRock. Officially, they cited sustainability concerns. They sold stakes in 2,600 companies to concentrate their portfolio in just 756 selected firms. But the timing, right as geopolitical uncertainty peaked, suggests the real driver wasn't just ESG, it was risk. When a €250 billion pension fund breaks up with the world's largest asset manager, that's not a portfolio adjustment. That's
A statement. And here's a statistic that should shock anyone watching from Europe. UK pension funds, the funds managing retirement savings for British workers, now allocate just 4.4% of their assets to domestic equities. 4.4%, down from over 50% historically. British pension funds have essentially given up on British companies. If British funds don't believe in Britain and Danish funds don't trust America, where is the money going? The data gives us a clear answer. Emerging market equities returned over 28% in 2025, double the S&P 500's 14%. Global emerging market ETFs saw $38.9 billion in inflows. Foreign direct investment in ASEAN countries rose 8% to $226 billion, while global FDI fell 11%. Manufacturing FDI in Southeast Asia, up 150% to $44 billion. Capital is voting with its feet. While political instability rattles the West, emerging markets, particularly Southeast Asia, are capturing the flows. So the picture seems clear, right? Central banks are dumping dollars. European pensions are fleeing. The exit is underway. Except, here's where most dollar collapse documentaries lose all credibility. They ignore the data that doesn't fit their narrative. I won't. Because the smart money isn't just fleeing America. Some of it is doubling down. Norway's government pension fund Global, the world's largest sovereign wealth fund at $1.9 trillion, increased their North American equity allocation to 56.9%. The US alone represents 53% of the entire fund, up from roughly 35% under their 2015 benchmark. Norges Bank, Norway's central bank, explicitly advised, reduce Europe allocation and correspondingly increase allocation to North America. Singapore's GIC, $930 billion, increased their Americas allocation to 49% in 2025, up from 44% the year before. Their Asia-Pacific exposure fell to the lowest level since 2010. Their CEO, Lim Chow Kiat, said publicly in July 2025, GIC will continue to have a large US exposure. The United States will remain an important investment destination. They expanded their US headcount by 30% over 3 years. That's not reducing exposure, that's building infrastructure to increase it. Temasek, Singapore's other sovereign wealth fund, at $389 billion, doubled their Americas exposure from 12% in 2016 to 24% in 2025. Meanwhile, their China exposure dropped from a peak of 29% to just 18%. Japan's GPIF, the world's largest pension fund, increased US Treasury holdings to a decade high, the exact opposite of what Europe did. Canada's CPP investments increased US exposure from 36 to 42%. And here's the number that seems to blow up everything I've told you. Total foreign holdings of US Treasuries hit an all-time record of $9.355 trillion. Wait, if everyone's fleeing, how are holdings at a record? This is where most analysts either ignore the contradiction or wave it away with conspiracy theories. I'm going to show you what's actually happening. Because once you understand it, everything else makes sense. Here's what most commentators miss. These funds aren't fleeing America. They're doing something much smarter. They're executing a barbell strategy. Think of your investment portfolio like insurance for your future. If you're worried about your house burning down, you don't move to a different house. You keep your house and you buy fire insurance. That's exactly what institutions are doing with America. They're not selling their American stocks. American companies, Apple, Microsoft, Google, still dominate global earnings. The institutions want that growth. But they're buying insurance against the dollar, gold, infrastructure, emerging markets, assets that go up when the dollar goes down. Picture a barbell. On the left side, American equities, the growth engine. On the right side, dollar hedges, the insurance policy. In the middle, the part they're getting rid of? US Treasuries,
dollar-denominated bonds. The very assets that are supposed to be safe. Look at the evidence. Singapore's GIC, 49% in Americas, but also 23% in real assets, up from historical averages. Norway's fund, 57% US equities, but their fund managers have publicly lobbied to add gold and commodities to their mandate. Currently, they're prohibited from holding them. They want permission to hedge. Temasek, 24% Americas, but 52% in Asia, excluding China, heavily weighted toward infrastructure. They want American companies. They're hedging American currency. That's not a contradiction. That's sophisticated risk management. It's the same bet, executed at institutional scale, that you cannot easily replicate in your 401k. So, when you hear de-dollarization, don't think flee America. Think hedge the dollar while keeping the equities. That's the institutional playbook. And here's the part that should concern you. The hedge side of the barbell: gold, infrastructure, private credit, commodities. Those are the assets that have outperformed over the last decade, and they're the assets you can't easily buy in your brokerage account. Institutions have access to investments you don't, and the gap is widening. But don't take my word for it. Let me show you 4 specific pieces of evidence that most financial analysts are afraid to discuss publicly. One involves a mystery buyer who shouldn't exist. One is a math problem with no solution. One rewrites what you learned in history class. And one reveals why the best investments of the decade are ones you can't access. Let's start with the mystery. Here's a puzzle that nobody can explain. From November 2024 to November 2025, China's treasury holdings fell from $768 billion to $682 billion, a decline of $86 billion in 12 months. That tracks with everything we've discussed. China is reducing dollar exposure, no surprise. But in the exact same period, UK Treasury holdings surged from $766 billion to $888 billion, an increase of $121 billion. The UK quietly became the second largest foreign holder of US Treasuries, surpassing China. So China sells $86 billion, and the UK, an economy 1/6 the size of China, buys $122 billion. In the same 12 months. Who is buying through London? Is the UK acting as a proxy for sovereign wealth funds that don't want their names on the ledger? Are Middle Eastern or Asian investors routing purchases through the City of London? Is this the Fed's way of masking weakening foreign demand? I don't know. And here's the honest answer. Neither does anyone outside a very small circle. But the numbers don't add up to normal market behavior. Something is being hidden. Now let's talk about a math problem that has no solution. In the fourth quarter of 2025, the US Treasury spent $276 billion on interest payments alone. That's $30 billion more than the same quarter the previous year. Annual interest payments are projected to exceed $1 trillion in 2026. $1 trillion. Just to service the debt. Not to pay it down, just to pay the interest. Here's what that means in human terms. Every single dollar of income tax paid by everyone in California, Texas, and Florida combined, it doesn't cover the interest payment, not even close. Interest payments now exceed military spending. The United States pays more to service its past borrowing than it spends to defend the country. And within a decade, interest payments are projected to exceed Medicare spending. This isn't speculation. This is the Congressional Budget Office's own projections. And the people who manage trillions, they see it too. Larry Fink, April 2025, warned that US debt could cost the dollar its reserve currency status, and mentioned Bitcoin as an alternative. Ray Dalio, December 2024. I want to steer away from debt assets like bonds and have some hard money like gold and Bitcoin.
It is impossible for these countries to not have a debt crisis in the years ahead. When the world's largest traditional asset manager and the founder of the world's largest hedge fund both say, buy hard money instead of bonds, that's not investment advice. That's a warning. Now let me tell you something that will change how you think about reserve currency transitions. Most people believe the dollar replaced the British pound as the world's reserve currency after World War II. Bretton Woods, 1944. The official coronation of American financial dominance. That's what the textbooks say. It's wrong. The transition happened 20 years earlier. By the mid-1920s, the dollar had already begun overtaking the pound in international bond markets. By 1929, the dollar had definitively surpassed the pound as the primary reserve currency. World War I had weakened Britain. The 1920s confirmed the shift. Bretton Woods merely formalized what markets had already decided. Here's why this matters. The people holding pounds in 1925 thought the British Empire would last forever. They saw the largest navy in history, the most extensive colonial network, a currency backed by centuries of stability. By 1945, it was over. The decline wasn't announced. It wasn't sudden. It was gradual, then sudden. 2008 financial crisis weakened US credibility, like World War I weakened Britain. 2022 weaponization of reserves accelerated alternatives, like the 1920s shift accelerated the dollar's rise. The question isn't whether a transition is happening. The question is, are we in 1925 or 1935? And now, the revelation that explains why this matters to you personally. The assets that have performed best over the last decade aren't stocks. They aren't bonds. They're alternatives, private equity, infrastructure, private credit. And the scale of this market is exploding. Global alternative assets under management, $16.8 trillion in 2023, projected to reach $32 trillion by 2030, nearly doubling in 7 years. The giants of this space, Blackstone crossed $1.27 trillion in assets in 2024. Brookfield exceeded $1 trillion in early 2025. KKR is at $664 billion, targeting $1 trillion within 5 years. Apollo manages $733 billion. And the pension funds, the ones managing your retirement, are shifting into this space as fast as their mandates allow. CalPERS, California's public pension, $503 billion, just approved increasing their private markets allocation from 33% to 40%. CalSTRS, California's teacher pension, is already at 44% alternatives, well above the 34% peer average. Here's the problem. You can't invest in Blackstone's infrastructure deals. You can't access CalPERS's private equity allocations. The minimum investment for most alternatives is $10 million. Some require $100 million. Think of it like a VIP room at a club. The best drinks, the best music, the best experience, all behind a velvet rope. And the bouncer's job is to make sure you don't get in. The best performing assets of the last decade, they're the ones you can't buy. The institutional class is moving to a game you're not invited to play. Infrastructure, gold, private credit, data centers. The institutional world is pivoting to things that can't be printed, can't be frozen, and can't be devalued by a central bank. But this raises a question. Why infrastructure specifically? Why now? Because Larry Fink isn't just hedging risk. He's positioning for the biggest investment opportunity of the century. Global infrastructure investment needs between now and 2040 $68 trillion. $68 trillion. Roads, bridges, ports, power grids, water systems, telecommunications, data centers. The energy transition alone requires $4 trillion annually, every year, for decades. This dwarfs any previous investment cycle in human history. It's larger than the post-World War II reconstruction, larger than the industrialization of China, larger than the internet build-out. And BlackRock is positioning to own it. After the Global Infrastructure Partners acquisition, BlackRock controls a $170 billion infrastructure platform.
300 investments, 100 countries. The AI infrastructure partnership with Microsoft, MGX, and NVIDIA. 30 billion committed, with a target of 100 billion. Building the data centers that will power artificial intelligence. When Aligned Data Centers was acquired for roughly $40 billion, BlackRock's infrastructure arm was at the table. Whoever owns the data centers, the power grids, the ports, the pipelines, they own the 21st century. And that ownership is being transferred right now from public markets, where you can buy shares, to private markets, where you need a minimum investment of $10 million. Want proof of the pivot? Look at how sovereign wealth funds allocated their capital in 2024. Infrastructure and real estate, 61% of total investments. Equities, 39%. For the first time in over a decade, hard assets surpass stocks in sovereign wealth fund capital deployment. The world's governments are buying things that can't be printed, can't be frozen, and can't be devalued by a central bank. That's not diversification. That's a vote of no confidence in paper assets. And even retail investors are starting to catch on. Gold ETF inflows in 2025, $57.1 billion. The strongest year in history. Global gold ETF assets are approaching $530 billion. The largest single-day inflow into GLD, the biggest gold ETF, was $2.2 billion. In one day. Gold prices surged past $4,000 per ounce in 2025, up roughly 60% from early 2024. But here's the difference. Retail investors are buying gold ETFs, paper claims on gold. Institutions are buying the mines, the refineries, the vaults, the infrastructure that produces and stores physical gold. When the next crisis hits, which do you think will be worth more? A claim on gold or the gold itself? The institutional class isn't just hedging. They're acquiring the assets that will matter when the paper burns. So now you've seen the full picture. Let me put it together for you. Because what I'm about to show you is the exact playbook the institutional world is running, and why it's designed so they can't lose. The institutional barbell. On the left side, US equities. American companies still dominate global earnings. Apple, Microsoft, NVIDIA, the institutions aren't selling these, they're increasing exposure. On the right side, dollar hedges, gold, infrastructure, emerging markets, private credit, commodities, assets that rise when the dollar falls. In the middle, what they're reducing, traditional US fixed income, treasury bonds, dollar cash, the safe assets that aren't safe anymore. Norway keeps US stocks, lobbies for gold. Singapore increases America's, grows real assets to 23%. BlackRock hits record AUM while pivoting 49% of new capital to alternatives. They're not choosing between America and the rest of the world. They're choosing between paper and things. Now here's what should make you angry. Larry Fink warns about the dollar crisis his firm is perfectly positioned to profit from. Think about it. If US markets rise, BlackRock's $14 trillion in assets under management generates fees. They win. If the dollar falls and hard assets rise, BlackRock's $676 billion in alternatives outperforms everything else. They win. If the entire system fragments, BlackRock's infrastructure empire becomes essential. Data centers, power grids, ports, the things civilization can't function without. They win. The house always wins. And here's the thing you need to understand. You're not the house. You're not even playing the game. You're the chips. Let me make this concrete. Your parents' portfolio, the one financial advisors have been recommending for 50 years, 60% stocks, mostly US 40% bonds, mostly US Treasuries. Assumption, stocks and bonds move in opposite directions. Bonds protect you in downturns. That assumption died in 2022. Stocks fell. Bonds fell with them. The worst year for the 60-40 portfolio since the 1930s.
The correlation broke, and it's not coming back, not while inflation risk persists and interest rates can't be cut to zero again.
The new model, Fink's 50-30-20. 50% stocks, more internationally diversified. 30% bonds, shorter duration, credit over treasuries. 20% alternatives, infrastructure, private credit, commodities, gold. The portfolio that worked from 1980 to 2020 doesn't work anymore. The people who manage trillions know this. They've already shifted. You're still holding your parents' allocation. Now, I'm not here to tell you what to do with this information. That's not my job. And I'm not here to tell you the dollar will collapse tomorrow. The pound didn't collapse overnight either. It took 20 years of gradual decline before Bretton Woods made it official. The people holding pounds in 1930 had 15 years to reposition before the final reckoning. What I am here to tell you is what the data shows. A structural trend of repositioning by the world's largest investors. Not panic selling, not a crisis. A deliberate, multi-year shift in how serious money is allocated. So let me give you the practical picture. Not as advice, as observation. Here's what institutional investors are actually doing. Geographic diversification. 40% or more international equity exposure. That's already the default in target date funds, whether you knew it or not. Hard asset allocation. 15 to 20% in gold, commodities, infrastructure. The hedges against dollar debasement. Private market exposure. 20 to 40% in alternatives, if they can access them, and most of them can. Duration reduction, shorter-term bonds, credit over treasuries, avoiding the interest rate time bomb. Currency diversification, non-dollar holdings, commodity exposure, the stuff that holds value when paper doesn't. This isn't a recommendation. This is a description of what the people managing $30 trillion are doing with their portfolios. What you do with that information is your decision. The mainstream financial media won't tell you this story. It challenges the narrative of American financial dominance. It suggests that the people managing your retirement have different interests than you do. It implies the system is designed for them to win, regardless of outcome. But the numbers don't lie. The filings are public. The gold purchases are recorded. The allocation shifts are in the annual reports. I'm not telling you what to think. I'm showing you what's happening. And the sources for every claim in this video? They're linked in the description. Go check for yourself. But before you go, I need to tell you the thing that nobody is saying out loud. Because the great decoupling that everyone's talking about, it's not what they told you. The great decoupling isn't West versus East. It's not America versus China. It's not even the dollar versus gold. Want proof? Despite 145% tariffs on Chinese goods, despite all the decoupling rhetoric, US imports of Chinese laptops and phones went up 50%. The trade war is theater. The supply chains are intact. But you know what did decouple? Market access. Institutions can invest in private equity, direct infrastructure, private credit, physical commodities. You can invest in public stocks, public bonds, ETFs. The best performing assets of the last decade? The ones in the VIP room you can't enter. The great decoupling is real, but it's not what they told you. It's not America versus the world. It's the institutional class versus everyone else. They're not decoupling from China. They're not fleeing America. They're decoupling from public markets, from transparency, from you. The people who manage your pension made their decision. The only question is whether you'll make yours, before the transition from gradual becomes sudden. Now I want to hear from you. Drop your prediction in the comments. Are we in 1925, the early stages where smart money is quietly repositioning? Or 1935, where the shift is about to become obvious to everyone? Let me know your take below. And if you want to stay ahead of the next economic shift before the mainstream catches on, hit subscribe. We cover the stories the financial media won't touch. I'm not here to tell you what to do.
I'm here to show you what they're doing. What happens next is up to you.